listening to OPIS Talks, where you'll be in on conversations with insiders in the energy, chemicals, and environmental commodities markets. Guests share insights into the latest trends and innovations, industry challenges, and much more. Let's dive into the conversations that explore where the energy economy is headed, right here on OPIS Talks.
My name is Mariana Santos Moreira, Thought Leadership Director at Chemical Market Analytics under Dow Jones Energy. And with me today is Joel Morales, our Vice President, North America Polyolefins. Welcome, Joel.
Thanks for having me.
Yeah, good to have you. So before we start with the Q&A, maybe let's set the scene for our listeners first. I would say the most pressing theme these days for polyolefin market participants and petrochemicals in general is obviously the Middle East conflict, which has fundamentally reshaped global energy and feedstocks markets. And the impact was really not homogeneous, and it really differed by region and by production process. So when it comes to polyolefins specifically, the crisis actually acted as a lifeline for some operators, accelerated asset shutdowns where critical feedstock shortages were felt more acutely. So today, Joel and I will walk our listeners through the key market drivers currently affecting global polyethylene and polypropylene markets. Without further ado, Joel, in this context, the first question is really critical. How has the current Middle East crisis impacted the polyethylene and polypropylene markets differently?
So this has been a historical experience. I've started to stop saying once in a lifetime experiences because in the last 25 years, we've had 9/11, we've had the 2008 financial crisis, we had COVID in 2020 and 2021, and here we are with yet another event. So I would hope 25 years, we're not going to have four major events like this. So I'll say that this is affecting the markets quite differently now. The crisis started February 28th. One of the major producers of polyethylene and polypropylene, the world's largest net exporting region, the Middle East, was significantly impacted immediately. And the thought process was, how is the world going to offset the loss of that much capacity? And we saw historical price increases in many parts of the world. And we've seen prices higher before. What we hadn't seen is the speed at which prices shot up within 30 to 60 days. And what that does is that puts tremendous pressure on the supply chain of making plastic things. If you think about the supply chain, a producer sells to a converter sells usually to an intermediary or third party that then finally sells towards the final brand owner and user. And throughout that process, you have inventory, and to have to pay such a high price right away before you can pass it on really puts people in a liquidity crunch that we've never seen before. So this has put tremendous pressure on global prices. Prices shot up, as I mentioned, globally at record paces in a short period of time. But I think the surprising part of this is how quickly prices have corrected and come down. So the Middle East is not resolved, obviously. The Strait of Hormuz is not open for 100% transit. But what we've seen is just China's ability to supply a lot of the world based on their massive amount of product that they happen to have on hand pre-conflict for a number of reasons. Maybe we can talk about that. But essentially, short answer is China really offset a lot of that Middle East production. The world has consumed less, and destocking global inventories has made this spike of prices going up come down. This thing started in February, prices shot up March, April, May, June have come down, and in July continue to come down in many regions. So in a 5-month wave here, even though things haven't been resolved, the world has kind of sorted itself out.
Right. And I mean, you already mentioned here that the Chinese producers, they really filled quite a bit of that gap that the Middle East created. And you mentioned inventories as well. I have another question for you that relates to this in two different fronts. So on the supply side, okay, China is a winner in this. Do you see the US producers as well as obvious winners in this present landscape? And then again, on the, you said inventory depletion, but Could there be actual fundamental demand erosion stemming from this, related to macroeconomic pressures? Or do you think these inventory drawdowns and the inevitable need to rebuild them will actually offset that potential end use and consumer demand erosion?
Let's unpack all that. Let's start with the comment on
Mm.
the Chinese producers. So Chinese producers have been introduced to buyers in Europe and Latin America, other parts of Asia, Africa. They've been introduced to people that they would not have been introduced to as quickly if not for this crisis. So that is a win for Chinese producers, Chinese traders, that this crisis has resulted in them establishing supply chains and relationships with buyers around the world that wouldn't have happened otherwise. So they have certainly benefited. We don't think that the rates at which they exported in the months of May and even June are going to remain in place. The timing of things, it just so happened that with Lunar New Year, the timing of that was pretty close to the timing of when the conflict began. And so resin producers at record levels, right? Because every month there's record levels of capacity in China for polyolefins because they continue to build. So we entered the year with the biggest footprint of capacity in China and will continue to do so every single year going forward. So they had a lot of material on hand. They had a lot of material that they'd imported also on hand because pricings at the end of last year and the start to 2026 were at very low levels, and Chinese traders like to buy low and sell high. So that combination of events allowed them to re-export some of that imported material to other markets that had better prices, and even some of the product produced in China was moved to other markets because of better prices. So they certainly benefited. U.S. producers of polyethylene, polypropylene. The polyethylene producer benefits when oil prices are high because oil sets the high cost bar for global production of polyethylene as well as polypropylene. And as everyone should know, North America utilizes natural gas-based ethane for the majority of its ethylene and polyethylene production. So as long as the spread between natural gas and oil is high, North America is in a great position. And so we quickly saw with oil prices initially escalated over 100, 110, 115, that tremendously benefited North America. We had 3 straight months of production at mid-90s, highest rates in the world. So they did benefit, but surprisingly, the volume of exports did not jump as anticipated because, as I mentioned, China was able to fill a lot of those needs in their own region in a quicker supply, shorter supply chains, quicker times to get there. So actually, the U.S. exports haven't done anything dramatic versus history, which is a bit counterintuitive, but they have benefited thus far with the escalation of the spread between natural gas and oil. However, now that natural gas prices still remain low, but as oil has come down, it was down in the low 70s last week. Now, with recent escalation between Iran and the U.S., oil's back into the mid 80s for Brent, which is the marker we typically use for polymers production in Asia. That spread is not where it was, but if it stays higher than pre-conflict levels, in pre-conflict in February, we were near $65. If that spread stays higher, it'll be beneficial for U.S. producers. On the polypropylene side, they don't have a structural cost advantage like they do in the polyethylene chain, but they did take advantage of the near-term call on some increased exports, strong demand in the marketplace, so they were able to raise their margins temporarily, and that was not the case that we'd anticipated coming into this year. Our expectation is that PP producers in North America might have to make some difficult choices and shut down 1 or 2, if not more, plants because they were at bottom of the cycle conditions. That now has been postponed. And the question about demand destruction. Demand is definitely down for polymers this year. Our clients can see in our monthly reporting, we were thinking the world would grow something between 3.5% and 4%. We're now looking at maybe 0.5% growth for polyolefins. That's a tremendous amount of demand that is being lost this year. One of the things people keep asking us is, wait a minute, in 2021, when there was a big winter storm in North America, there was big disruption in a lot of the world that lasted for quite a bit of time. Why is this event over so quickly? The world was growing much faster in 2021 than what we're seeing today. And so when the world's not growing, it does make it easier for your existing supply to catch up to what demand you do have. Now, to your specific question about do we think that demand comes back, we do have growth in our forecast for next year. We will have positive growth for the world this year, but you just don't go back and consume things you didn't consume. You didn't buy that refrigerator, you'll buy it next year. In some parts of Asia, we've seen less plastic use. We've seen a great bit of conservation, not only in refined products and work from home, but also in some places where they've just consumed less because of pricing and availability. So we don't believe you're going to see that 3% lost in 26. All of a sudden, you add that to 27 growth. That's not in our modeling. So unfortunately for resin producers, they don't get that demand back. And unfortunately for resin producers, the amount of capacity that looks to be offline because of damage in the Middle East, it's really not enough to offset that loss in demand and change any of these conditions. So when we look at what the story is for the next few years, and this story is still being written, so every day we look at the news and see what's going on in the Middle East, and if there's additional damage, what's the price of oil? Is the Strait going to allow flow? Is the Red Sea going to become involved? Is there going to be constraints there? But for what we know now, our assumptions are, as we go into 27 and 28, global resin producers are still facing those oversupply challenges. There's just not enough demand to absorb the amount of capacity that's still out there being led by China.
Thanks so much, Joel. That was very insightful, and there's a lot to unpack there. So I wanted to focus on a few key messages and just maybe get a few more thoughts from you on those. So you did say that inventory levels were quite high before this crisis, so that was a pretty significant buffer. You also mentioned that demand is not really going to pick up after all of this is resolved. So the question is, are we really not expecting inventory levels to go back to what they were before, or what is your sentiment there?
The biggest area we saw where we know we had a lot of inventory ahead of the conflict was based in China. And China is such a big part of the world now on a capacity and a demand basis. Our view is that China will and is in the process of restocking, but they're more in a buy what they need mode as opposed to we think the prices are low, let's really load up and have high inventory. So we're seeing more kind of hand to mouth buying to the end of this year. And when we forecast normal buying patterns around the world in our regions, we get a 2027 demand profile that's not too different than what we were expecting for 2027 before. Yet 26, we're losing somewhere like 3% of global demand for polyolefins. So that's why when I look at things and say we don't make it up, that consumption is just lost. And that's negative from the producer side because you have a lot of capacity and you want the opposite effect, right? We need more demand, not less.
Right. Okay. Yeah. And the other thing you said that I thought was really interesting was the fact that US exports haven't actually picked up that much. But you did say that China actually exported quite a lot more than they used to. And from my understanding is that they actually flipped their net importer position since the conflict in the Middle East began. So I'm getting from all that you're saying that this is going to be a temporary situation.
Yeah, technically, just the month of May, we had them on polyethylene becoming a net exporter. That's rare. On the polypropylene side, China had already been growing its PP export business and was expected this year to be a net exporter. So that trend's not so surprising. But the PE trend was a bit surprising to a lot of folks. At the end,
Yep.
China's production did not fall as much as many people might have thought. They did increase coal-based production. Anything that was ethane imports based ran well. And between their reserve draws and bringing in perhaps more crude from other markets. And the reality is you look at the news, and I don't think anyone in the world knows exactly the amount of oil that's actually flowed through the Strait of Hormuz with all the cloak and dagger and ships turning off their transponders. So I get the sense that the amount of oil that went to China is a bit more than people thought and allowed them to keep continuing to run their plants harder than initial assumptions.
And the last thing that I wanted to revert back your comments on is it's the bottom of the cycle conditions that we were seeing before the crisis started, right? So you did mention there that some U.S. producers had some difficult decisions to make and some shutdowns that they were planning because the market was oversupplied and has been put on pause at least during the crisis. So the question is, what about beyond the current situation? What is the longer term outlook looking like compared to the baseline for all of this?
I think the baseline longer term, medium to longer term, we're pretty close to the same position as we were pre-conflict. We're in a global market that's oversupplied at historic levels for polyethylene and polypropylene, again, driven by China's quest for self-sufficiency. And in many ways, China is such a big market, and it's though they've been building with complete irrelevance to what the rest of the world was doing. In other words, the rest of the world might have been building to export to China at a cost position, perhaps, and China has just built irregardless of that. And so the math looks pretty daunting. I think US-based suppliers of polyethylene will have an advantage for their assets there because they're natural gas based. Our view is with the price of oil and natural gas through the medium term is they'll make money, bottom of the cycle type money. But some of those US producers have assets that are not cost advantage in Europe and other parts of Asia, so they'll be challenged on those assets. And on the polypropylene side, where they don't have an inherent cost advantage like ethane gas, I think those decisions are going to come up again. We need a lot of capacity to come out of the market, or we need to wait patiently for demand to catch up with this capacity. And our analysis says that doesn't happen this decade.
All right. Well, thank you so much, Joel, for joining me today and for sharing your insights and expertise. There's certainly a lot more that can be said about every single one of these themes and their impact to polyolefins markets. Joel will be presenting about the global polypropylene markets, how the current landscape influences supply, demand, and producer profitability, including our revised price assumptions and the new energy-driven trade forecast, the Global Plastic Summit in Houston, Texas, from the 2nd to the 4th of November. So please do join us there, continue this conversation, be part of the discussion shaping the future of the industry. You can now register at chemicalmarketanalytics.com/GPS, and by using promo code TPOD15, that's TPOD15, you can get an additional 15% discount. So thank you again, Joel, and thank you for tuning in.
No problem. Thank you.
We hope you've enjoyed today's insider conversation on OPIS Talks. Join us next time for a deep dive into another industry insider's world. You can find more OPIS Talks episodes at opisnet.com/podcasts or wherever you listen to your favorite podcasts.